Welcome to the deep dive. We don't just scratch the surface here.
Nope.
Today, we're really getting into Huntington Bank Shares' latest Q2 earnings report and also the investor call that went with it.
Yeah, there's a lot there.
There is. We've got stacks of financial details, strategic insights,
Yeah.
direct from the CEO, the CFO, other senior folks there.
Yep.
And our mission really is to figure out Huntington's secret sauce. How are they managing growth and resilience in, well, today's banking world?
Exactly. And you might just glance at an earnings report and see numbers, right?
Right.
But we want to sift through that, pull out the really important bits for you.
Help make sense of it all.
Yeah, help you understand what truly matters in this update. Because there are, some surprising things, broader implications. It paints a clearer picture of where Huntington's actually headed.
It's like the shortcut to getting smart on this key regional bank.
That's the idea.
Okay, let's unpack this then. Starting right at the top, the headline numbers.
Okay.
Huntington reported earnings per common share EPS of $0.34 for Q2.
34 cents.
Yeah. Now, that was flat compared to the previous quarter,
Wow.
but it's up 4 cents compared to this time last year. So year-over-year growth.
That's solid improvement.
And their net income for the quarter, $536 million.
Okay.
Which is up 2% from Q1, and actually a pretty big jump, 13% from Q2 last year.
Wow, that 13% jump in net income.
Yeah.
That's pretty impressive, isn't it?
It really stands out.
It really backs up what the CEO, Steve Steiner, was saying. He called it strong operating performance with robust organic growth.
Right.
And, that's not just fluff. It signals real positive momentum. The business is doing, quote, exceptionally well.
And ahead of plans for the year.
Exactly, which, tells you their strategies are likely working.
I agree. And the CEO's comments really connect there. He talked about how they're growing. It's about getting new customers, sure, but also going deeper with the ones they have.
Deepening relationship.
Yeah, and expanding both sides of the coin net interest income and fee-based revenue.
Right.
That focus on the customer relationship, that really seems to be the heart of their organic growth strategy.
It does. It feels very intentional.
So with those strong top-line figures set, let's pull back the curtain a bit.
Look under the hood.
Exactly. See what's driving this performance from the inside. The core banking stuff.
Loans and deposits.
Let's start with loans. Average total loans and leases, they grew by $2.3 billion. That's a 2% increase just from the prior quarter.
Okay.
And year over year, it's up $9.8 billion, or 8%, bringing the total to $133.2 billion.
That's a lot of lending. Serious activity there.
It is, and let's break that down a bit. Average commercial loans grew $1.6 billion, or 2% from Q1, and $6.7 billion, 10% year over year.
10% growth in commercial, okay.
And on the consumer side, average loans grew $725 million, or 1% from Q1, and $3.1 billion, 6% year over year.
So growth across both, but commercial seems particularly strong year over year.
It does.
And what's interesting, too, is where all that growth is coming from.
Right. It's not just the usual suspects.
Well, their core businesses definitely contributed, but a big chunk, maybe 40%, around $900 million of that quarterly loan growth, came from their newer initiatives. Things like their expansion into Texas, the Carolinas.
Oh, and now in South Carolina, right.
Yeah, and specialized areas like their financial institutions group, funds finance.
So they're actively seeding new growth areas.
Exactly. They're not just relying on the old playbook. They're building new engines.
Okay, so if lending is that strong, the logical question is, how are they paying for it all?
Funding it, yeah. Deposits.
Let's look at their deposit strategy. Average total deposits were up $1.8 billion. That's 1% from the prior quarter.
Okay, modest quarterly growth.
But year over year, it's $9.9 billion higher. That's 6% growth.
Almost mirroring the loan growth dollar amount year over year. Interesting.
Yeah. And their focus, they say, is squarely on acquiring and deepening primary bank relationships.
Makes sense. Stickier money.
And apparently it's working. Those primary relationships grew 46% year over year in consumer and business banking.
46%. That's huge.
It really is.
And what's fascinating here really is how they managed this deposit growth while being, well, super disciplined on pricing.
Meaning they didn't have to pay up too much for those deposits.
The overall cost of deposits actually declined by 1 basis point in the quarter.
Declined while growing deposits.
Yeah, they're optimizing, right. They had slightly higher cash balances because deposit gathering was strong, so they used that cash efficiently to fund loan growth.
Ah, so using their own internal liquidity buffer?
Pretty much. It lets them fund growth without putting too much pressure on their net interest margin. It's a smart balancing act. Shows strong operational control.
Very intentional, like you said. Okay, so that's the funding side.
Mm.
Beyond the interest they make on those loans, how else are they making money? Let's look at net interest income, NII.
Right, the core earnings driver for most banks.
It increased $41 million. That's up 3% from Q1.
Okay.
And compared to last year, it's at $155 million, or 12%.
12% NII growth year over year. Strong.
And their net interest margin, the NIM, that spread we talked about, it was 3.11%. That's up 1 basis point from the prior quarter.
So stable to slightly up. That's good to see in this environment.
And part of that, they mentioned, was a 2 basis point benefit from a lower drag from their hedging program.
Ah, yes, the hedging.
Yeah.
That expanded NIM is exactly what the CEO flagged as a key profit driver.
Right.
And they've been pretty strategic about hedging. You can think of it like insurance almost.
Protecting themselves.
Yeah. Protecting capital if rates spike higher, but also protecting the NIM if rates suddenly fall. They're aiming for kind of a neutral position, stable regardless of rate swings.
That stability is valuable. Investors like that predictability.
Absolutely.
Okay, so that's interest income. What about the other side? Non-interest income. Fees, basically.
No, fee income.
Now, the overall number decreased, but there were some specific one-off things in there.
Like a securities repositioning loss, I think.
Yeah, and some credit risk transfer impacts. But if you strip those out...
Look at the core underlying trend.
Exactly. Non-interest income actually increased. It was up $37 million, or 7% from Q1.
Okay. Decent sequential growth.
And up $34 million, also 7% from the year-ago quarter. So solid underlying growth there, too.
And what's driving that growth? They mentioned specific areas.
They did. They highlighted strong performance in what they call strategic fee income areas.
Things like payments, wealth management, capital markets.
Exactly. Those areas.
And if we, connect this to the bigger picture, those strategic fee areas are becoming a much bigger deal for them.
How so?
Well, they grew 11% year over year, combined. And now they make up 66%, 2/3 of Huntington's entire fee income mix.
Wow. So it's not just a side business anymore.
Not at all. It's a strategic shift. They're diversifying away from relying only on lending. It makes their revenue more resilient.
Can you give some specifics on those areas?
Sure. Commercial payment revenues were up 18%. Treasury management fees up 10%. Their commercial card portfolio had the second highest growth rate in the industry last year.
Impressive.
Wealth fees climbed 13%. Assets under management grew. Capital markets income was up 15%, driven by things like underwriting and syndications.
So it shows a real push to offer businesses and individuals more than just a checking account or a loan.
Exactly. A full suite of services. Value-added services.
Okay, that covers revenue pretty well. Let's shift to the foundation, the strength of the bank itself. Credit performance.
Always critical. How are their loans performing?
Pretty well, it seems. Net charge-offs loans they actually had to write off were just 0.20% of average loans in the quarter.
20 basis points. That's quite low.
And it's actually 6 basis points lower than the prior quarter.
So improving even from a good level.
Yeah, they point to their disciplined credit risk management and client selection.
And that 0.20% figure, it really does signal very strong credit quality currently. Now, what about potential future problems? Non-performing assets.
Good question. The NPA ratio loans not currently paying as expected was 0.63% at the end of the quarter.
Okay, 0.63. How does that compare?
It was up just slightly, 2 basis points from the prior quarter, but they emphasize it's been in a really tight range for several quarters.
So stability again, not seeing a major spike in problem loans.
Seems that way. And their criticized asset ratio actually decreased. The allowance for credit losses, their buffer, is still hefty at $2.5 billion.
Did they mention that $76 million increase in C&I non-performing assets?
They did. They characterized it as idiosyncratic. Basically, a couple of specific one-off situations, not a sign of some broader weakness starting to show.
Okay, so context is important there, not a systemic trend.
Right. Now, let's talk capital. How well capitalized are they?
The buffer against losses.
Exactly. Their Common Equity Tier 1, or CET1, risk-based capital ratio was 10.5%.
10.5. Solid.
Yeah. And even the adjusted CET1 ratio, which smooths out some volatility from investments, that was 9.0%.
9%. How does that fit with their targets?
It hits the lower end of their target operating range, which is 9–10%. So they're right where they want to be. And their tangible common equity ratio, TCE, that improved too, up to 6.6%.
So capital levels look healthy, meeting their targets.
They do.
So this raises an important question, I think. What does all this capital strength actually mean for the owners, for the shareholders?
Good point. How does it translate?
Well, look at tangible book value per share, TBV. That jumped substantially. It's now $9.13.
Okay.
That's up 4% just from the prior quarter, and a really impressive 16% from a year ago.
16% growth in TBV per share in a year. That's significant value creation.
It really is.
Yeah.
And you pair that with a strong adjusted return on average, tangible common equity ROTCE of 17.6%.
17.6% ROTCE.
Yeah, excluding some of those one-off items we mentioned. It really shows their model isn't just generating profit, it's a powerful driver of shareholder value.
Okay, that paints a very solid picture of the current operations. Now, what about strategy? Big picture moves.
Yeah, future growth drivers.
One of the biggest announcements recently was their plan to combine with Veritex Holdings.
The Texas Bank, right?
Exactly. They're framing this as a way to accelerate Huntington's organic growth initiatives in the dynamic Texas market. Seems like a major strategic play.
It absolutely feels like one. And management laid out 4 main benefits they see.
Okay, what are they?
First, it gives them a real, meaningful presence in Dallas, Fort Worth, and Houston. They call it a springboard for substantial future growth there.
Makes sense. Major markets.
The second, it brings over, quote, an outstanding group of new colleagues and a strong commercial banking franchise. Notably, Malcolm Holland from Veritex will become chairman of Texas for Huntington.
So acquiring talent and expertise, too.
Third, they stressed it's fully aligned with our model, delivering broad banking capabilities, but through local teams and relationships.
Fits their existing approach.
And fourth, simply that it's financially attractive for both sets of shareholders. It seems like a strategically sound move that fits their mold.
And what specific opportunities does this open up in Texas?
Well, they see it accelerating their commercial lending and capital markets activities there pretty quickly.
Leveraging Veritex's base.
Right. Plus, it brings new fee income streams, especially in payments and wealth management, areas where Huntington is strong.
Okay.
And it really fast-tracks building out a consumer banking presence in Texas. Veritex already has, over 30 branches?
Right.
So Huntington can layer its full range of consumer products and digital capabilities onto that existing footprint much faster than starting from scratch.
It definitely speeds things up in a key growth state.
Absolutely. And Texas isn't the only place they're expanding strategically.
Where else?
They mentioned adding a new middle market banking team down in Florida.
Okay, another high growth state.
And they're continuing what they call full franchise expansion in North and South Carolina, opening more branches there.
The Carolinas seem to be a big focus for them.
Definitely.
Yeah.
They pointed out that the Carolinas are outpacing the rest of the country in job growth, population growth, like almost twice the rate.
Wow.
So they're doubling down. Several more branches opening there by the end of this year, and plans for over 20 more next year.
So Veritex is a big acquisition, but they're still pushing organic expansion in other key markets, too.
Exactly. It's a multi-pronged growth strategy.
Okay, so looking ahead then, what's the path forward? They updated their guidance for the full year, right?
They did. And it looks pretty confident.
So.
They actually increased their guidance ranges for growth. Loan growth for the full year 2025 is now expected to be 6-8%.
Up from what it was before.
Yeah, they nudged it higher. Same for deposit growth, now expected to be 4-6%.
Okay, so anticipating continued momentum.
And maybe most significantly, they raised their net interest income, NII, guidance to 8-9% growth for the full year.
8 to 9% NII growth.
And they specifically noted that hitting that level would mean record net interest income on a full-year basis for Huntington.
A record year for NII. That definitely signals confidence.
It really does.
What about fee income and expenses?
Fee income guidance, they kept that the same, expecting 4-6% growth for the year.
Okay.
On expenses, they're guiding to 5-6% growth. Now, that might sound a bit high, but they explained it's mainly due to two things. Higher incentive compensation because revenues and profits are looking better than expected.
So paying for performance.
Right. And some volume-related drivers tied to the growth they're seeing, but they reiterated the focus is on driving positive operating leverage.
Meaning revenue growth should outpace expense growth, efficiency.
Exactly. They also gave some specific pointers for Q3, expecting about 1% loan growth sequentially. Deposits may be flat, then growing again in Q4.
Okay.
NII roughly stable compared to Q2. Fee revenues around $550 million, and expenses may be a bit higher, around $1.22 billion, because of some planned marketing for a new brand campaign.
Good to have that near-term color. Anything else on the full-year outlook?
One more positive adjustment: credit quality.
Ah, yes, the charge-offs.
Given how strong the first half was, they lowered their full-year net charge-off guidance, now expecting just 20 to 30 basis points for the year.
0.2 to 0.3%. That's fantastic. Really reinforces the strong credit story.
It absolutely does. And overall, you just got a sense of real confidence from management on the call.
Yeah.
Phrases like "never been better positioned," talking about the durability of their model, their ability to deliver on guidance, risk management being core to their culture.
Sounds like they feel they're firing on all cylinders.
Pretty much. They expect to keep generating that positive operating leverage, supporting attractive growth in revenue and profit, which then opens up strategic options, like the Veritex deal, to fuel even more long-term growth.
Okay, so wrapping this all up, what does this deep dive really mean for you, the listener?
Well, I think the clear takeaway is Huntington Bancshares is showing some serious momentum right now.
Yeah, it's not just growth. It feels like disciplined, purposeful growth.
Exactly. You're seeing impressive loan and deposit numbers, yes, but also smart financial management, optimizing funding costs, strong credit discipline.
And strategic expansion into those key high-growth markets like Texas and the Carolinas.
Right. They're clearly focused on deepening those primary customer relationships and diversifying revenue with more fee-based services, moving beyond just basic banking.
They seem to be executing well on that strategy.
Which brings us to maybe a final provocative thought for you to chew on.
Okay, let's hear it.
Consider how Huntington's strong emphasis on, deepening primary bank relationships and really leveraging these value-added fee services, payments, wealth, capital markets.
Yeah.
How that might actually represent a broader trend, maybe even a blueprint, for other regional banks trying to find sustainable growth in today's, evolving economy.
Interesting. So is this integrated service model the future?
Well, that's the question, isn't it? What does this focus on integrated services really mean for the future of banking relationships? Not just for the banks themselves, but for you as a customer.
How might your own banking needs and relationships change in that kind of landscape? Something to think about.
Definitely something to think about.